In modern finance, the same asset can be used more than once. A government bond posted as collateral in one transaction can be reused in another. This practice increases liquidity and efficiency. It also creates chains of dependency that stretch across institutions. When markets are stable, collateral reuse enhances capital flow. Assets move through the system, supporting multiple transactions without visible strain. But when stress emerges, these chains tighten. If one link fails, others must adjust immediately. Collateral that appeared abundant can become scarce overnight. The system depends not only on asset value, but on asset availability. This is the story of collateral chains, how a single security can underpin layers of leverage, and what happens when the chain is disrupted. Collateral is an asset pledged to secure a loan. In secured funding markets, high-quality government bonds are commonly used for this purpose. Once posted, collateral can often be rehypothecated, meaning the receiving party can reuse it in another transaction. This reuse creates chains. One bond may support multiple loans as it moves through financial intermediaries. Each transaction appears safe individually, but collectively they form a network of obligations. Collateral chains developed alongside the growth of repo markets and derivatives trading. They enhance liquidity by allowing capital to circulate efficiently. However, the true length and density of these chains are difficult to measure in real time. Institutions track their own exposures, but system-wide reuse is opaque. The system functions smoothly as long as collateral remains acceptable and freely transferable. Collateral reuse promises efficiency. By allowing the same asset to support multiple transactions, the system reduces idle capital. Institutions can fund positions at lower cost. Liquidity increases. The practice is not inherently destabilizing. High-quality collateral, such as government bonds, is considered reliable under most conditions. As long as counterparties perform, reuse enhances flexibility. The broader promise is scalability. Financial markets can expand without requiring proportionally larger capital buffers. Assets circulate rather than remain static. Regulatory frameworks recognize collateralization as a risk mitigation tool. Secured lending appears safer than unsecured borrowing. This perception reinforces reliance on collateral chains. The flaw lies not in individual transactions, but in interconnected layering. When the same asset underpins multiple obligations, disruption in one segment can ripple outward. Efficiency increases during calm periods. Complexity increases simultaneously. Collateral chains expanded significantly after the growth of derivatives and repo markets. Financial institutions sought ways to optimize balance sheets and reduce funding costs. Rehypothecation provided that flexibility. Large broker-dealers became central nodes, receiving collateral and redistributing it across markets. Hedge funds relied on this structure to leverage positions. Banks relied on it to manage liquidity. The practice became embedded in global finance. Cross-border transactions added additional layers of complexity. Legal frameworks differed across jurisdictions, affecting rights to collateral during stress. Because government bonds were perceived as safe and liquid, reuse was considered low risk. Market participants focused on credit quality rather than chain length. The rise of collateral chains reflected rational incentives: maximize efficiency, minimize idle capital, and enhance return on equity. What few considered was the fragility created when multiple institutions depend on the uninterrupted flow of the same assets. Collateral chains fail when confidence in collateral quality or counterparty reliability weakens. If lenders demand higher haircuts, more collateral must be posted for the same level of borrowing. This requirement can strain the system rapidly. Institutions may need to recall collateral that has already been reused. Downstream borrowers must replace funding or unwind positions. The chain reaction is mechanical. One adjustment forces another. What was once abundant collateral becomes scarce. In times of market stress, even high-quality assets can be questioned. Liquidity conditions tighten. Legal disputes may arise over collateral ownership rights, particularly across jurisdictions. Because reuse magnifies leverage, forced deleveraging can accelerate price movements. Selling pressure may reduce asset values, further increasing collateral requirements. The system does not collapse because collateral disappears. It collapses because its circulation slows. Opacity compounds the risk. Institutions know their direct exposures, but cannot easily map the full chain. Stress in one segment may surface unexpectedly elsewhere. Collateral chains are not inherently unstable. They are conditionally stable. When trust holds, they enhance liquidity. When trust weakens, they amplify contraction. The vulnerability lies in simultaneity. If multiple institutions seek to secure collateral at once, demand outpaces supply. The system's strength during expansion becomes its constraint during stress. A severe collateral disruption would manifest as widespread margin calls and funding stress. Institutions would reduce leverage. Repo markets could tighten. Derivatives exposures would require additional collateral. Central banks might respond by expanding eligible collateral categories or injecting liquidity to stabilize funding markets. The collapse would likely be partial rather than absolute. Chains would shorten, reuse would decline, leverage would contract. The impact would not be visible to retail investors immediately. It would emerge through volatility, widening spreads, and funding pressure. Collateral chains do not fail spectacularly. They constrict. After stress episodes, institutions reassess collateral practices. Haircuts increase. Transparency improves incrementally. Regulatory scrutiny intensifies. Yet efficiency incentives remain. Reuse persists because it enhances profitability during stability. The system adapts, but the underlying mechanism endures. Collateral chains remain a structural feature of modern finance. Collateral chains illustrate how financial systems optimize for efficiency at the cost of clarity. Reuse enhances liquidity during calm periods, but embeds dependency across institutions. The risk is not deception, it is layering. When the same asset supports multiple obligations, resilience depends on uninterrupted trust. Collateral is often described as safety. In chains, it becomes linkage. Understanding these chains is not about predicting crisis. It is about recognizing that circulation can become congestion. Modern finance moves assets continuously. When movement slows, fragility becomes visible.